Howdy, folks. Welcome to Liberty Call. Today is Tuesday, April 9th, 2024. Hope you are having a fantastical day out there in the interwebs. It is a beautiful day here in Colorado. It's in the mid-50s. I got shorts on. It is amazing. So sun's out, guns out. Anyways. All right. Well, like I said, hope you're having a good day. And if it is your first time watching the Liberty Call, if you could give me some thumbs up, a like, a share, a subscribe, a follow, and press that notification bell. Because, again, I might say something smart tomorrow or Thursday. I don't know which. I'm saving them up. So anyways, all right. Looks like the markets were not in a friendly mood again today. Let's go ahead and jump over there and take a peek. Dow Jones finished in the red, down 0.02%, 9 points, closed at 38,883. S&P 500 up 0.14%, closed at 5209. NASDAQ up 0.32%, closed at 16,306. The VIX fell 1.38% today. It's at 1498. Canada up 0.46, Brazil up 0.8, and Mexico down 0.72%. In Europe, Germany was down 1.32%, the UK down 0.11%, France down 0.86%, the Netherlands down 0.43%, Spain down 0.88%. Italy down 1.08%, Switzerland down 0.36%, and the lone bright spot, Portugal, up 0.17% for the day. Russian exchanges both red, MOEX down 0.12%, RTSI down 0.37%. And the Asian markets, Nikkei in Japan was up 1.13%, Australia up 0.45%, New Zealand down 0.13%. In China, the Shanghai was up 0.05%, the Shenzhen component up 0.58%, China A50 down 0.38%. DJ Shanghai up 0.18%, Hang Seng up 0.57%, and the Taiwan weighted up 1.85% for the day. So I'm not sure what was wrong with Europe. They were all in a bad mood except for Portugal. So is what it is. All righty. Well, let's move over to the market recap. Stock market or S&P 500 ekes out a gain as focus shifts to key inflation reports. Wonder what it's going to tell them. Probably inflation's still hot, and they're not lowering rates anytime soon. That would be my guess. Man, my beard's looking like a scraggly mess. That's what my father told me 2 weeks ago when I saw him. He's like, I said I look like a bum or something. I need to trim this up. Anyways, let's dive into this first article. On Tuesday, U.S. stocks experienced a modest gain though investors navigated fluctuations between losses and gains amidst pressure from a tech decline led by NVIDIA, just ahead of key inflation data. NVIDIA's 2% dip below a crucial technical level of 850 triggered additional selling pressure, coinciding with Intel's announcement of its Gaudi 3 chip. I hope I pronounced that right, which promises improved performance and energy efficiency. Nonetheless, Wolfspeed Inc., Global Foundries, and Amkor Technology Inc. buoyed the chip stocks, with the latter surging over 7% after Needham initiated coverage with a bullish outlook. In contrast, Alphabet saw a more than 1% decrease following its unveiling of new custom ARM chips and cloud business partnerships. Attention now turns to Wednesday's consumer price index. Inflation data expected to show a potential uptick in inflation. Who's been saying that? Though the core measure is anticipated to cool, sticky inflation remains a concern for the Fed, potentially influencing interest rate decisions. Yeah, they're not lowering rates until things either get messy in the market or the economy slows down. There's really no reason to lower rates other than it just helps out Wall Street and big business. Where was I? Wednesday also brings the release of the Fed's March meeting minutes, offering further insights into future rate cuts. Despite the Fed's guidance for rate reductions, traders are tempering expectations with a 54% chance of a 25 basis point cut in June, according to the CME's FedWatch tool. Meanwhile, Boeing faced fresh woes as the FAA initiated an investigation following whistleblower reports of flaws in the 787 Dreamliner. This development compounded with recent incidents contributing to Boeing's declining stock and reduced aircraft deliveries in the first quarter. On a positive note, Lucid Group Inc. saw a rise in its stock after reporting first quarter deliveries exceeding market expectations, driven by price cuts, boosting demand for its luxury electric sedans. However, financials traded below the flat line as major banks prepare to kick off the first quarter earnings season, leaving investors attentive to whether the recent surge in valuations can be justified. Probably not. I think the market's way overvalued, but that's just one guy's opinion. Sitting here at the base of the Rockies. All right, next up, got some data on small business. U.S. small businesses business sentiment slides to lowest level in more than 11 years. Well, that's not positive news. In March, U.S. small business confidence declined to its lowest level in 11 years, as reported by the National Federation of Independent Businesses, the NFIB. The Small Business Optimism Index dropped to 88.5, marking its lowest point since December of 2012, and continuing a 27-month streak below the 50-year average. Concerns about inflation were paramount, with 25% of owners citing it as their top operational challenge, reflecting increased input and labor costs. Businesses also reported a rise in average selling prices, aligning with consumer price increases observed in various sectors, including finance, retail, construction, wholesale, and transportation. Despite this, hiring plans among small businesses weakened, reaching their lowest level since May of 2020, even as certain industries face acute labor shortages. The U.S. economy added 303,000 jobs in March, with the unemployment rate dropping to 3.8%. However, inflation remains a concern, with expectations of a 0.3% increase in the consumer price index for March, following a 0.4% rise in February. Year on year, CPI is projected to have risen 3.4% in March, surpassing the Fed's 2% target. Amid these economic conditions, there is anticipation that the Fed may initiate interest rate cuts this year. I doubt it, although the timing remains uncertain. The Fed has maintained its policy rate within the 5.25 to 5.5 range since July, and has raised the benchmark overnight interest rate by 525 basis points since March of 22. So again, small business sentiment is down, and everyone's wanting lower interest rates, which again, it's not happening anytime. And again, interest rates aren't going back to zero. Oh, I mean, they may go back to zero if the markets implode and the economy is a complete disaster. I wouldn't be shocked if the Fed went back down to zero for a short bit. But if it's just a slight move, I mean, they're not going back to zero. If that's what you're hoping to get your mortgage at 2 or 3% again. So it's not in the cards, folks. All right. Some more awesome news. President Biden to cancel student debt for millions more Americans. Isn't that nice for President Biden to do that with our money? It's great, isn't it? Let's read into this. President Joe Brandon is set to announce a significant expansion of student debt cancellation measures during an appearance at a community college in Madison, Wisconsin. The plan aims to provide relief to nearly 1 in 10 Americans burdened by student loans. Well, maybe they should pay them back. I've paid back all my debts over the years. With the administration's proposal includes canceling interest payments for about 25 million borrowers whose debt has grown since they initially took out the loans. Yeah, that's part of the contract, dummies. Forgiving the debts of over 2 million Americans eligible for existing federal debt forgiveness programs, and erasing loans of approximately 2 million individuals whose debts older than 20 years. Combined with previous measures, these actions would reduce student debt for an estimated 30 million people. I call them thieves. Secretary of Education Miguel Cardona emphasized the transformative potential of these measures, highlighting their role in promoting social mobility and economic prosperity. Well, speaking from a taxpayer's perspective, I don't like having to pay off other people's bills. So there's that. The proposed interest cancellation alone would have broad-reaching effects, potentially forgiving up to $20,000 in interest payments for households of all income levels, and offering complete interest forgiveness for two-person households earning up to $240,000. That's a pretty good living, folks. I'm sorry, the government's stealing from you. And this is not a left-right thing. This is, I hate the government, regardless of who's in charge. Overall, the Biden administration estimates that more than 10 million people could receive over $5,000 in debt forgiveness, with 4 million individuals receiving their entire outstanding debts forgiven. The implementation of these relief measures is expected to begin in the early fall, although specific timelines were not provided. Yeah, this is basically just a bribe so that young, stupid people will vote for this idiot. This student debt relief initiative is part of a broader youth outreach effort with Vice President Kamala Harris, Second Gentleman Doug Emhoff, that's just funny, and Secretary Cardona also participating in the events across different cities to promote the administration's plans. However, it remains uncertain whether the impact of these measures will be felt in time to influence the November election. Well, of course not. It's going to go to court. If it goes to the Supreme Court's going to say, sorry, you can't do this. But anyways, I mean, even that dingbat Nancy Pelosi years ago said that you couldn't just wipe away debt, student loan debt, with a executive order or whatever they're trying to do. So Anyways, boy, that got my blood pressure up, nice and pumping. All right, last up, maybe some positive news. Could fractional reserve banking work with a gold standard? I don't think so, but let's see what this is a Q&A. The question comes from Kyle P. and that Peter Jacobson is the author of this article. All right. Understanding how banking functions under a commodity standard like the gold standard requires delving into the dynamics of the currency system and banking operations. Commodity money, such as gold-backed currency, operates differently from fiat currency due to the concept of redeemability. In a commodity-based system, currency can be exchanged for a physical commodity like gold, whereas fiat currency is only redeemable in itself. Back in the old days, before FDR confiscated all the gold, you could take your paper, ones, fives, 20s, and you could exchange them for gold and silver, depending upon the type of paper that it was. So, and you could also take raw gold to the treasury and they would press it into, gold coins or whatever. So I'm sure they had a nice little fee for doing that, but, you could always exchange your currencies for actual money. Under a commodity standard, such as the gold standard, banks can still operate within a fractional reserve banking system. Here's how it works. When an individual deposits $1,000 worth of gold at the bank, they receive 1,000 in redeemable gold-backed notes in return, just like the old days. These notes can be used for transactions and are redeemable for their portion of the gold. If the individual decides to save the notes instead of spending them, they can deposit them back into the bank. When another individual borrows notes from the bank loans out the portion of deposited gold-backed currency. For instance, if $800 worth of notes were lent out, the depositor's account remains at $1,000 while the borrower receives $800 in physical cash. The system is known as fractional reserve banking and allows banks to lend out a fraction of the deposited money while keeping the rest as reserves. However, a potential issue arises when the bank effectively creates new money by lending out a portion of the deposited funds. This situation leads to more currency promises in circulation than can actual amount of gold held at the bank. While this risk exists, it's not unique to commodity-based systems and applies similarly to fiat systems. The choice of commodity to back a currency depends on several factors, including its universal acceptance, portability, durability, diversibility, fungibility, and scarcity. Metals like gold and silver often emerge as preferred commodities due to their high value density and relatively stable supply growth. Other commodities such as copper or distilled water may lack the value density or scarcity required for effective currency backing. Ultimately, while commodity-backed currencies present unique challenges for banking systems, they are not inherently incompatible. Understanding the qualities that make a certain commodity suitable for currency backing is essential in designing robust monetary systems. And it would certainly be better than the system we have today where nothing backs it. And, the Fed just prints money anytime that there's some sort of a disaster that they want to cover up or, help us out with. So anyways, and we know what happens there. That just creates inflation, and then your donuts and your Cheerios are, 30 or 40% more expensive 2 or 3 years later. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you guys all have a wonderful evening, and I shall talk to you next time. Adios.